Broadcasting from the commodity capital of the world, Zurich, Switzerland, this is Insider's Guide to Energy.
This edition to Insider's Guide to Energy is brought to you by Fidectis. Go to www.fidectis.com for more information.
Welcome to Insider's Guide to Energy. I'm your host, Chris Sass, and with me is co-host Johan Oberg. Johan, what's going on today?
Hey, Chris. Doing fine. It's another good week, but more interested about hearing your latest adventures taking Insider's Guide to Energy on the road.
Yeah, we had a great time. We were in Dallas, Texas, and we were at a show. We hosted a panel on fleet to grid, and that was an amazing conversation. It was full house. They actually had a bouncer at the door. We were keeping people from coming in because the fire marshal capped the room for the attendance at that. And then also interesting, and I posted a photo online this week, is I got to meet Marcelo, one of our producers who does Insider's Guide to Energy stories. So that was kind of fun because we've been working together with just a face for a long time. So it was good to go have a beer with him as well. So it's been a great trip.
Fantastic. So, yeah. No, but it's fantastic, and you can see traveling or not, but actually you can see more and more offices were, opening up. Lunch meetings are getting back on again. We're starting to meet people again. It's fantastic.
Yeah, I think it was with 14,000 of my closest friends in Dallas. So it was a big show again, and the industry is going strong. But hey, let's talk about what we're going to talk about this week, because I think what was interesting is when you and I were catching up when I got back to town. We were just kind of shooting the stuff, and we were talking about the industry, and you had talked about insurance and energy. And for me, that was about the most foreign thing. And it really hadn't crossed my mind. And you kind of said you just recently had a conversation, and I lit up because our guest this week happens to have a energy tech company that does that. And that's just amazing that this is coming up in everyday conversation, or at least for a couple energy geeks.
No, I agree, and I'm quite pleased. I'm really looking forward to it. And saying that, I'm not really the big expert in terms of what this complies, what it actually brings, but in discussions, it has come up. And I had a lunch meeting not long ago when we actually talked around this and reinsurances of everything. And you look at the energy industry in general, it is about taking risk, and risk is also part of insurance. So it's not far-fetched, but we haven't had it on this show yet. So it's going to be really interesting to dig in a little bit. And also what I like about this one, it's related also to a startup. So it's not just taking the traditional more of a reinsurance or insurance part, but it's actually looking at it, hopefully, in a new way.
Well, but I think that's what's important, right? So you have energy tech companies doing things that are enabling. So we talk about energy transformation. We talk about all these new cool things. There's trillions of dollars getting pumped in, but we really need every element. So when we talk about energy, a lot of times we get focused that it all goes back to politics. Well, politics is one of the legs of the stool.
Correct.
But risk is certainly another leg of that stool. And so I'm happy to do that. But rather than us going back and forth, why don't we invite Jeff to the program here? Hey, Jeff, welcome to Insider's Guide to Energy.
Thanks. It's really wonderful to be here.
Well, so I know who you are. Johan knows who you are. But what I'm going to let you do is introduce yourself to our guests and the name of your company and what you do. Let's start there, and then we'll go into a conversation.
Wonderful. So I am Jeff McAulay, one of the co-founders of Energetic Insurance, and we offer data-driven risk management solutions in the form of insurance. And our mission is to accelerate and expand the market for renewable energy solutions. And we're doing that by really participating in that project finance ecosystem to more efficiently shift risk from maybe a sponsor or a debt balance sheet to an insurance balance sheet. We'll get into a little bit more details there.
All right, so that's a mouthful. Help me understand then where you are as a company. I think Johan said we also like to talk about different companies. We talk about you being energy tech. So you've got a very specific problem you solve in the industry. Where's your company at?
Yeah, we're headquartered in Boston. We're about 15 people now, growing rapidly. We raised a Series A last fall and have deployed our insurance products across a wide range of industry verticals, states, and growing quickly, both expanding in terms of the geography and product types that we're covering. So it's a really exciting time.
Well, I'd love to hear new companies coming in. Having lived in the Boston area for years, it's fun to see another tech company up there. It's always been a tech mecca, I think, in the Boston Northeast area. So if you work in California, you are tended to be in Boston, in my experience. So how is it going for you guys? So you're where are you at this stage?
It's a really exciting time. We started 5 years ago launching a new financial product. And as you guys were just saying, insurance is sort of this, feels like an esoteric financial product. And often sold, never bought is one of the adages, right? When you're talking to somebody about insurance, they go, "Oh, why'd you buy it?" "Well, because I had to," right? Or "How much should I get?" Just more than you think you need. We take a completely different approach. So personally, me, my co-founder, we didn't come from an insurance background. We came from an energy background. We came to insurance as a way to solve problems and take on risks that weren't being efficiently borne, in our experience, by other market players. And primarily, I think when a lot of people think about insurance, they think about property damage, or they think about weather. In fact, these aren't the real risks that are holding back the market today. They're there, they're important. There's advanced and sophisticated products to mitigate those risks. The bottleneck risk that we felt, and most acutely in commercial industrial solar, was counterparty risk. So I'm going to say that a different way. It's not the supply, meaning whether or not the sun's going to shine, whether or not the module is going to perform. It's about the demand. Is there going to be a buyer there? And I started as an engineer. I've worked in applied R&D labs. So for me, that's a wonderful place to be from a technology perspective, that the industry isn't worried about the modules crapping out. There's great confidence. There's great warranties that these things are going to last 20, 25 plus years. Now we're getting to the stage where can more businesses, can more institutions access cost-effective renewable energy? And that is about, is there going to be demand? That's called credit risk, and that's the product we offer.
So if we're going to start from there, and might be a little bit of a naive or stupid question. I don't know how I'm going to formulate it. But for me, when I think about insurances and I think about risk taking, in the back of my head, then suddenly it sounds large, muscle, financial capital, you name it, in order to support this. So how does this work for you guys as a startup, as a smaller company, and kind of maybe go through a little bit where you sit in this value chain? Because I'm trying to get my head around how you as a startup company can actually fill the big shoes, which in my head is the insurance part of it.
You're absolutely right. And we are very fortunate to be in a structure that's very common for insurtech startups like us, referred to as a managing general agent or managing general underwriter. So you'll hear people talk about MGA, MGU as this model where you can have a startup company that brings a novel product to market, but still partners with the large insurance and reinsurance balance sheets. So in fact, that's what we do. And so our focus as that managing general underwriter is we developed our own data sets. We've built our own underwriting tools. We've built our own in-house actuarial software. We've really designed this product. We do the distribution, the analysis, the risk pricing, and then we team up with a large balance sheet, as you said, the muscle and the capital behind it. And we agree upon a set of guidelines that allows us to go sell that product in the market. But ultimately, the balance sheet behind it is that large rated insurer.
So, credit risk is simply just, there's a dollar amount or a value, right, put into the deal to make the deal work. So how big a magnitude and how many more deals get to go through if I can insure it where I might be willing to take that risk than had I not, from, let's say, I think from reading some of your documentations, large banks and others are signed up to work with you guys. So are you facilitating more deals this way, or is it just another to make better, less risky deals?
Yeah, and there's a little bit of both, but I would say what we experience, what we've experienced personally, what we hear from our customers, credit increasingly is a binary issue. You can either get the deal done or you can't. You can either get the debt or you can't, and it's less of a sliding scale. So we literally have projects where we have a developer who's coming to us, they just cannot get debt, and we turn a no into a yes. And so those are really, those are great stories. That's super valuable. And then it's not just that, it's also the time. It's a developer who's been banging their head up against this wall. They're trying to figure out all of these creative solutions. Can I get a parent guarantee, a loss reserve, a letter of credit, a personal guarantee, all these things. And it's just taking forever and it's frustrating the customer. Whereas we can come in and we can make a much simpler, much cleaner solution and accelerate those deals. So that's on the binary side.
And what kind of costs are you talking? You're talking like a point? You're talking a percentage of a point? You're talking multiple points?
Yeah. So this is the wonderful thing, and also maybe goes to more of the sliding scale. Oftentimes there's a bank will say, oh, okay, we'll do it, but it's going to be at a 1.4, 1.5 DSCR, right? Or there's going to be at a 40% loan to value, or there's a shorter amort, higher interest rate. There's all sorts of levers that go into cost of capital. And so when we talk about the price of the product, we really put it in the context of the value. What is the developer trying to do? They're trying to get the best levered IRR. So if we can create a picture where they're improving their levered IRR, then it makes sense. If we can't, don't buy it. And we're in there in a collaborative dialogue with that developer to help structure the deal in a way that works. And at the end of the day, we price the risk. So we're taking into account the off-taker, the aspects of the energy project, regulatory incentives. We're taking that into account. And if the price is too high, it means the risk is too high. And we're willing to work structurally to get around some of those things.
So how much of this then, being, as you described in the beginning, a fairly limited size of company as of today, working with hopefully scaling the number of customers, traditionally, this is a kind of a long-term manual or labor-intensive or hour-intensive process. So how much of this, I would assume, as an insurtech or insurtech, how much of this is automated, and where do you bring that kind of technology value from what kind of have been in the past?
Absolutely. And that's really, I'm glad you brought that up. That's really one of the core elements to our thesis, is that if we're going to go from those super massive 100 megawatt scale transactions down to the 500 kW 1 megawatt types of deals, and also in portfolios of deals, it has to be software driven. So we build software tools for our internal underwriter users to speed up that process. So from the first moment we get a deal in, we're pulling dozens of data sets about that site to help inform qualifying it in, qualifying it out, and informing the inputs to our actuarial models. And then we're able to run tens of thousands of scenarios to help us inform the risk pricing that ultimately comes out. And that enables us to scale with a relatively lean team because we're building those software tools, because we're building the data analytics to help inform the risk.
So right now, you talked about having a lean team. Do you have APIs and applications or an ecosystem that you're working with as well? So do you see insurance agents or other resellers in the energy business, or maybe some software platforms that are designing, planning a PV installation and hooked right into your application? Is that part of your vision, or is it a direct customer model?
Absolutely. And that's, as the industry standardizes, we can't force that entirely ourselves, but to the extent that there are standard design platforms or project finance pro formas, we want to ingest those on a standardized template, on an API if available. So yes, absolutely. That's part of the vision.
And how far away is that? I mean, you said I can't imagine why your company isn't influencing the entire industry. You sound huge, but sarcasm aside, how far away is that from potentially happening, or do you have a small ecosystem already in place? Are there some that are already doing this?
we're having that conversation actively now, and I think we can. We certainly like to think that we can punch above our weight in terms of influencing that. Meaning, hey, developer, if you want to get these deals done, these are the standardized tools that you should be using, and it's going to make your life easier because you can get a push button quote. Here are the standard templates you should be using, and that'll make your life easier because you're not going to be tied up in legal due diligence. And here are the standard, SNDA or UCC, whatever it is. Here are the things. Here's the playbook. You come to us with this package, it's going to turn around much, much faster than otherwise. And that acceleration is something we think we can add to the picture.
So how did you come up with this idea? So you said you and your co-founder came from the energy business. What were you seeing? What was the problem statement out there that made you have an aha moment to at least start the 1.0 of your company?
Yeah, and I think the vision comes from, like many folks out there, just banging our head up against that wall of trying to finance distributed energy projects with really substantial commercial industrial customers. Everybody immediately goes to, if it's not Fortune 500, it must be SME. There's very large, stable businesses out there that just happen to not have an investment grade rating or be rated at all. And so my personal experience was working at a company called Enernoc, which is now NLX, and having tens of thousands of commercial and industrial customers. We had direct relationships with the property managers. We had bill and tariff information, electricity usage. It was a very close relationship. And yet when I was working on building a distributed energy resources team and upselling solar batteries to those customers, we ran into this challenge of 90% of that customer base. And in general, when we look at the world of C&I customers, 90% don't have that investment grade or rating even at all. And so as an industry, we have to ask, does that mean that we only want solar and storage at Fortune 500 companies? Or do we want that distributed energy to be accessible to more businesses? And so seeing how pervasive that challenge was inspired us to start Energetic Insurance. And also, what's more, we think that risk is being mispriced. And I think a lot of folks out there, developers, banks, they recognize there's some common sense risk mitigants that are out there. But a lot of times within the finance industry, and this is a good thing, they need to have the credit bar met. You don't want an individual bank underwriter just kind of shooting from the hip. It'll be fine. 20 years? Yeah, no problem. We got this. Like, you actually want our financial industry to have rigorous standards. However, there's some complex underwriting that we can do that we think can price the risk more effectively and transfer that counterparty risk from the banks that really aren't designed to take it to an insurance balance sheet that can handle some of those risks.
So if I look at that, and you mentioned NLX and your previous one, and talking about these 90% without the credit ratings, for a little bit of an understanding, being coming out of the US, do you see differences also in geographies around this in terms of how you can approach as an SME or even a large company without a credit ratings? Is this applicable about the same if you look at from your platform and your customers, or is this a specific US challenge for now, or how do you see this? Because what we discussed on this show a little bit is regional differences and especially continental differences. So is there a difference, or is all customers the same for your platform?
There are definitely nuances in different regions, but this is a global problem. And that was actually part of the inspiration. So my co-founder, Jim, was working as a developer in Mexico. I was exploring solar plus storage projects in Africa and Asia. And it was the realization that, oh, wow, these long-term credit agreements, these long-term offtake are running into the same problem all over the world. It was that inspiration that led us to believe this is a company. This is something that really needs to be tackled in a systematic way.
So what is it that you understand that people didn't in the risk exposure, right? So how are you looking at this 20 years and perhaps, the business credit is less relevant, but you're looking that there's going to be a customer or some viability there. What makes your crystal ball better than the other ones?
Yeah. And I want to start by saying there is real risk here. We're not saying that there isn't. And there will be claims. There will be losses. So ultimately, that's what insurance is for, is not to say oh, we're smarter than you. There won't ever be anything that goes bad. There will be. I think what we're taking a different look at is when it comes to credit, our thesis is that electricity is a fundamentally different type of obligation than the other traditional forms of credit. It is the last bill that gets paid. So we have a different thesis on the probability of default, as evidenced by many businesses will keep paying for electricity through bankruptcy restructuring. Secondarily, and you alluded to this, is electricity is a different type of commodity in that it is, in many cases, fungible, tradable, reusable, valuable to any business, regardless of it's not a custom asset. It's really something that has use for really any purpose that uses energy. And so combining those theses, we have a different view of probability of default and loss given default that through our modeling and software, we're able to come up with a price. And so I think that's approaching conventional wisdom, but it's been really difficult to take that and package it in a financial product that works for the industry. And that's really what we've done.
Now, do any very large institutions want to use your software to self-insure? So are they using your actuarial tables or software actually to calculate their own risk and do performance themselves?
It's a great question, and one that we've gotten some requests of, hey, can we use you in another form? Today, we're only offering our services through the insurance product, but if people have that question, it's something that we're actively exploring, and there may be other ways for us to monetize what we've built.
I'm still a little bit curious in terms of if we stepping away a little bit from the actual technology and the platform itself and the industry. But if you look at from when you started and you sat around that table and thought, this is an idea that we have together, where did you see, why didn't anyone else do this? Is it because is it related to the change of the energy industry, the transformation of solar specifically? Or if this was just too small of a volumes, or where, because it feels like this should have been addressed, especially on a global market with so many customers, but it feels like a totally missed blue ocean kind of a thing.
Yeah. Well, I want to be clear. I think we are absolutely innovating, and I think I agree with that statement. But I want to give some credit to the existing industry. There are forms of trade credit that are sold on renewable energy projects. They're just bought and sold on investment grade renewable energy projects, very, very large scale. Yeah. What we've been innovating in is bringing that down the credit curve and down to smaller markets. There have been credit enhancements sold for utility scale projects in the developing world. They're just done by DFIs in the form of bespoke bilateral negotiations. That exists. It's just not a private sector instrument. So there's been a tremendous amount of innovation in this space. What we're trying to do is make that more commercial, more scalable, both to scale up, but also scale down to the smaller project sizes and be able to do those better, faster, cheaper.
So are you at a 1.0 release now? Are you at commercial use right now? Where are you along the life cycle of your solution? And I assume you're a software as a service kind of a offering, or is it just the service and you get the financing, or it's not really financing, but the insurance?
Yeah, really today I would call it a technology-enabled solution or an InsurTech platform, because ultimately the product that we're selling is insurance. And that was deliberate. When we were first starting the company, we looked and said, okay, well, we know credit is a barrier. We think it's being mispriced. And there were other entities at the time that had tried this, developing a new score. Oh, we'll use our software. We'll give you a new credit score and just trust us, right? And we quickly determined that the industry needed a financial product, not an information product. These kinds of standards take decades to establish, and ultimately it's about providing something that removes the pain point. Nobody wants another report. They just want to know that they're covered. And so that's why we went to the insurance model. In terms of where we are, I think we've got commercial product in the market. We've got a large and growing insured portfolio. And I think it's still early innings in the sense that we are now at a very exciting time showing the expandability of this approach. So not just behind the meter solar plus storage. We're expanding into energy efficiency, microgrids, utility scale, virtual PPAs, and international are all on the docket for expansion this year. So that's what we're using. We raised a Series A in the fall. We're using those funds not to just do the slow one at a time growth, but to really show this is a huge problem. The TAM is not just C&I behind the meter US. This is global, it's multi-asset, it's multi-structure, and it's a super exciting time.
So go ahead, Johan.
So with this, it just brings straight away to when describing this growth and you're describing this scenario around it, something that I'm always interested in. And when I have the opportunity to ask it, I'm always trying to ask it. And that this is a big opportunity, I can understand, as you describe it. But who is your customers? If the transformation is happening now, you talked about working with partners, etc. You start looking at maybe the architect or the house owner. Who is the customer? Because your portfolio is growing. It's your customer base. I'm not talking about the number of customers, of course, but also who you're dealing with.
Absolutely. It's a really important question because we designed our business model and go to market to be lean and focused on our role where we can add the most value. So we are not going out and trying to be a solar project developer. That's really important. It's difficult. It involves a lot of hand-holding, procuring modules, getting permits, designing systems. That is very, very well done by expert, centralized, and regional developers. We want to work with those expert developers to help them grow their business faster, for them to serve more customers. I would say the same thing on the lender side. Banks are a really important stakeholder. We don't necessarily sell directly to them, but we do have banks that come to us and say, hey, I can't get this through credit committee. Can you help? And so when we think about lenders and developers, those are our channels to market. So we can efficiently reach many, many off-takers without Energetic having to be the one that's knocking on all the doors.
Can you share a user story or a success story? I mean, obviously, you've got some stories here. I think that would help put it all together. So
absolutely,
maybe maybe a small, medium, and large scale. Let's figure out like the different scale that you've come across.
Absolutely. So the small scale multi-tenant retail. So there's an outlet shopping center north of LA. A lot of people have been out there, might know it, and it's one where there's a bankruptcy remote special purpose entity that owns the property. Very common in commercial real estate. There's huge names behind it, but they're not putting they're not putting that balance sheet behind every purchase made by that local entity. So here was a case where we could underwrite the credit of that building based on our analysis and help get financing. That was one that basically turned a no into a yes. And now that business, we think, is actually more creditworthy. Why? The solar they installed is on a parking canopy. So out in LA, that's creating shade for cars. Customers may shop longer if their car's not baking in the parking lot. Now you've got a platform for installing EV charging on a critical thoroughfare on a major highway. So we actually think that not only are we taking a good risk, we're making that site more creditworthy because the solar is enhancing value for that site in multiple ways. So that's a single case study that we worked on. Moving to a larger one, there's another public example where it was a portfolio financing, and in fact a refinancing, where there's dozens, if not over 100 sites of operating projects where the developer was looking to take advantage of lower interest rates and wrap that portfolio. And so we were able to help bring in a bank that provided overall better cost of capital for the entire package. And so those are sort of the small, medium, and then we're about to hopefully we'll be able to announce them soon, but much larger utility scale deals where we have an unrated retail energy provider. And so they're trying to go out, they're trying to increase the amount of solar they're providing for their customers, but they just happen to be unrated. And so this is very difficult for them to compete with all of the larger folks, but they still need to get in the game. And we're helping them get a seat at the table, get access to renewable energy for their customers. So that's kind of the small, medium, large approach, and showing the versatility of our underwriting and our product.
So how unique is what you do to the industry? Are there a number of other startups trying to do this, or some insurance companies trying to do this in a different way? Because we talked about it becoming more mainstream, talking about insurance and energy. So
Yeah,
how crowded is
there
the
are.
space?
I'll take a couple directions of that. So one, there are a small number of renewable energy MGAs like us, and that's energetic, KWH Analytics, Resurety, and maybe New Energy Risk are the folks that are in that category. So tech-enabled risk management. Not all of it has to be directly insurance. Some of them are derivatives, but tech-enabled risk management for renewable energy. KWH and Resurety are really covering the supply. Energetic is covering the demand. New Energy Risk is covering the technology risk. We're covering the offtake risk. So all of those are very, very complementary. They're not competitive, but there's this small class of folks that I would say like us. In terms of alternatives to insurance, obviously there's a large and growing renewable energy industry without us. So what's happening? A lot of those on the portfolio basis are able to get the deal done, but they just need to have 80% of the portfolio be investment grade entities. And so what we're finding is, well, the world isn't composed of 80% investment grade. So yes, these companies are able to get the deal done. We think that needs to be 70, 60, 50. We're working on portfolios now that are 50% investment grade. And that allows many, many more deals to be done while still keeping overall costs of capital low. So I think that's the other piece. In virtual PPAs, what's our competition? Competition is cash. Companies are literally parking cash that just tie up for decades to hold in reserve. And this is a great opportunity for, instead of just piling up cash there, having it do nothing, that you take a off-balance sheet insurance product to cover that same risk.
That's pretty interesting. I'm going to change gears a little bit and talk a little bit about the company. So what are some of the things, I mean, you both came from the energy industry, you decided to go into insurance. What were some of the hurdles or challenges to doing this? It seems like a pretty big pivot.
Absolutely. And it's not easy. It took us a very long time to, from that first concept to get capacity. And so, Johan, going back to another, why haven't people done this? If you walk into an insurance boardroom and you say, I want to take 10-year counterparty risk on small unrated businesses, you can guess what that reception is. So we had to learn the language of insurance. We took an outsider's approach and a customer-centric approach. And this seems totally intuitive to anybody working in product management or anybody working in a software startup. It is very foreign in the insurance industry. The insurance is about selling what you already have and forcing people to buy it, right? We took a completely different approach. And that took time. We were very fortunate to have early support from the US Department of Energy in their Sunshot program. And we were very fortunate to have early stage seed support from some very forward-looking investors. Congruent Ventures in specific was one of our largest early investors. And so we had a very, I'd say, pretty long, like a 2-year time cycle where we were learning how to develop our models, build some of the initial software, learning how to pitch that to insurance, and then finally get to market. And then, oops, COVID hits. And then, so it's definitely been a slog, but a lot of that, I think, respect and brand cachet that we've built in the industry comes from the fact that we've really stuck to our guns, that we weren't some blitz scaling, SaaS software company. We're really true, deep, committed energy people trying to solve problems in new ways. And, after a couple of years, I think we started to get that recognition. Oh, these guys aren't going away. Oh, they're really doing something. Oh, wow, this is actually useful. And so that building momentum it's taken time, the blood, sweat, and tears of any startup, but it's hard developing new financial products. I wouldn't, question of like, would we do it again if we knew how hard it was going to be? I don't know, but it's been a tremendous journey.
So what skill sets do you hire on your team today? So what are the employees you're bringing in? What are they? Are they mathematicians? Are they, what are they?
Great question. So I'd say we have three core components of the team. So when we're growing in all of these, right? So one is the business development sales. Jim and I have done a lot of that. We need to hand off and really have a team that can go out and pound the pavement and just continue to raise awareness. So sales and marketing, we've brought on some new folks there recently and continue to grow there. The second one, of course, is our technology. So we're hiring software developers, data scientists for the core tech team. And then the central piece is obviously our underwriting. And the underwriter at Energetic has this really interesting role because it's both facing the customer, but also continuing to design and improve our technology solutions. So we think of them as the underwriting product manager.
And I couldn't help laughing before when you say coming into an kind of a traditional company trying to change anything. I was working in my previous career on UBI insurances in terms of changing, especially for the automotive industry. And I know the challenges working with some of the insurance companies. But if we look a little bit on the company as well, coming back to the growth, you're mentioning the people and the kind of the what you're looking for in terms of the growth in numbers and in markets. The cases you described for us was U.S. centric. Is U.S. market it's obviously one of the largest markets, so I can understand if you make it there, you make it anywhere. But is that your core footprint today, or are you also internationally, or are you looking to go international?
We have just hired, I think whether it closes today or next week, we've just hired our first European-based employee because we have some very large project opportunities in Europe. Super, super important. This was one that we were just compelled even last year as we saw kind of storm clouds on the horizon, and has only been reinforced by unfortunate recent events. We have got to, have got to get more renewable energy to displace fossil fuels in Europe. That's never been more important. And that's not just the big rated companies. It has to be for the broader society. So I'm thrilled to be working on some large scale projects, first in Spain, but eventually broader in Europe. It's not easy to set that up, but we've been working on that for some time. So yes, international is in our future, and part of what we're trying to demonstrate.
So what lessons have you learned so far along the way? What didn't go the way you expected it to go?
Everything's always slower than you want it to be. I think that's maybe always a true statement. Is that unexpected? Maybe not. I think largely if we look to what our original thesis was, our original slide deck back 5 years ago and what we're doing now, it's substantially similar. I think that, the challenges of introducing a novel financial product are real, and just doing that education. We're dealing with very large risk averse entities, folks that have, done things a certain way. So that's certainly been a challenge, but I don't know that that's surprising. And there's always leaders and laggards in the industry. And we've been fortunate to have some really strong lead adopters that we've been working with. In terms of what's surprising, I'm surprised we haven't had a claim yet. I really would have expected, especially through COVID.
Since you just said that, your phone's probably going to ring in the next 5 minutes.
No, it's important. I said this earlier, like, this is not a business where we're expecting to, and in fact, that's one of the most common questions we get is like, have you played? So I'm excited for the day that we can say, yes, we've paid a claim. Obviously I don't want it to be a catastrophic loss, but that's why we got into this business. And we're working with partners that have a very strong track record of claims. And if you talk to good insurers, they brag to you about their claims. It's a point of pride, right? And so maybe I'm surprised, but I look forward to that day when we can demonstrate that the product works by paying out.
And then where does it go from here? It sounds like you've got a good vision. You're at a starting point. You're starting a journey. I mean, although 5 years sounds like forever, but in startup world, that's probably just about the right amount of time to be where you're at. Maybe a little slower with COVID. But where do you go? Is it just scale?
I think it's Yeah. You said, do we scale?
I said, is it just scale?
Is it just scale? That's a great question. So I do think it is about scaling in the dimensions that we discussed. So showing that we can support energy efficiency, virtual PPAs, international. That's a really important part of scale. And then also continuing to grow with our current partners. The other KPIs we have are continuing to increase the efficiency with which we are able to underwrite. So shrinking that time per closed deal, increasing our hit rate, speeding up that process for our customers, and increasing the predictability of close. I think all of those are really important metrics for us as well. So scale, efficiency, and then ultimately insurers are judged by their loss ratio. So we do want to have some losses. Those need to be proportional to what we're taking in. So I think that'll be an important metric to track over time.
And you said predictability of close. Is that kind of prejudging if someone's going to qualify for the deal, or is it a question of you put the terms on the table and the terms just don't make the balance sheet work the way they want and they walk away?
We have a lot of customers who come to us in the early stages of project development saying, we don't know if we can get this deal financed. So the more that we can give that certainty, those are developers they're buying modules, they're pulling permits, they're doing real work, they're putting capital at risk in the process. And so we have a great track record today of being able to help developers say, no, I know you were worried, you were rightly so worried about being able to finance this. We're going to very early on in that process give you the confidence that this can get financed.
So if I come back a little bit to, you open up the European one, switching a little bit here, but do you see any differences in terms of the different markets from your point of view of what is happening in that process? Is it quicker in one? Is it other obstacles in the other? Is this plain vanilla? It's the same challenges, same problems everywhere?
There are, of course, some similarities. And what we're really excited about is the ability to rapidly customize our models to work in multiple markets. I would say that even in the US, it's good training because every state is different. If you think about electricity prices, regulations, net metering, it's just very, very different from Florida to Hawaii to Nevada to California. I mean, anybody who knows these markets knows they're very different. So I think that was good training for us going internationally. And then, there are huge differences now. And where part of the reason that we look to Europe in particular is there's a lot of volatility in the US with tax equity and the availability of tax equity. Now we're seeing this come up again with tariffs and module supply. And so those are things that are very, very acute in the US that may be less so in Europe.
Now, do you need to get licensed in each jurisdiction then? So what states and how many states are you active in right now? And then what countries, I suppose, or is it?
Yeah, so we're active and licensed in 26 states in the US. Insurance is regulated on a state basis. So we have our surplus lines license, all of our appropriate licenses needed to sell insurance in those states. We are also getting set up in the EU, as I mentioned, going through all of the appropriate hoops. We're not the first, so there are support services in place to allow us to do that. And yes, that'll be our first European expansion.
So when you graduated high school and said, I'm going to do something to change the world, did you ever think you would be in insurance?
Definitely not. And I think, energy engineer Jeff was always taught to be a little suspicious of finance people, I guess. So I think I don't know that I ever would have expected this, but in terms of looking for a lever to move the world, and I mean leverage originally in the sort of Archimedes sense rather than in the financial sense, but maybe it's both. I can't think of a better tool to use at scale than insurance. And so in that way, I think really happy and increasingly seeing that as a tool that can be used very, very broadly for the mission of global decarbonization.
And what are the risks that you foresee that make this not work in the future? What potentially are pitfalls that this strategy isn't widely embraced?
It's a great question. And there's good and bad on that. Recording this now, there are some very real national, global, systematic financial risks. We've had, we as a renewable energy industry have benefited from a decade of super low, near zero interest rates, which have been really important in fueling low LCOE and in fueling deployment. So we're about to see how that is handled by the industry. We think Energetic can help there by narrowing spreads in certain cases. So cost of capital is very much part of the strategy, but there's unknown outcomes there. And so I think one of the biggest risks is a lot of banks. We're coming out of a very frothy period where there's a lot of capital, very competitive. Everybody's trying to get into ESG. So I'm worried about the renewable energy industry getting a black eye with a wave of defaults that make this look, oh, wait, no, it's not investable. So I think that's one of the concerns I have. So part of why we're here is to help. We don't want there to be a black eye on the industry. We want to come in and share in that risk and do our part to make sure that we ride through the next cycle.
But I think people realize it's the Wild West. I mean, I can just get some investors together and call myself a developer and put a PV park in the US. And folks are doing that, and some with great success, some making some money on it. It's boom times, right? But I also think there'll be consolidation and it will mature as the industry goes. But I don't think anyone would be surprised by that. Maybe an average shareholder or something like that might be, but most of the industry see that happening around them. I don't know, Johan, you see the same thing? I mean, that's kind of my take. Johan?
Yeah, I think it is. It's convergence and of the entire industry, and we see that across. I think also touching back to what Jeff was talking about in terms of the black eye. I think there is interest rates going up. There's world financial status that wasn't a few years ago when there was a lot of capital available, and the question is if investments in renewable will take that hit if we go back to basics, maybe. But I think also balancing this, the convergence of companies, merger of companies, I'm pretty sure it will happen. It always happens in these growing industries. But I also think it's quite interesting then, which was actually leading me to one of the questions, Jeff, and that is, if the financial industry and the capital of investing in this is decreasing a little bit, especially in Europe, I'm not really sure about US, but I would assume also in the US, there are government spendings that still lies there. And I think that's also something that is financing to enable this green transition. And I would assume that could be an interest even for you guys then to say, we are part of this one. So I don't know, chuck us some money, but that might compensate a little bit of the black eye from the kind of the traditional financial industry.
Yeah, well, I think so. There's multiple flavors of capital, and all of those are structured to bear different types of risk. So for the sponsor equity, levered making mid-teens, low teens returns, yes, they're built to handle that. Some of the banks that were out there lending at 2, 3, 4% are not necessarily structured to handle a downturn. So it's really about allocating risk and return appropriately. That's what project finance is all about. In terms of the role of government, I think that's a very interesting additional topic. We could have maybe a longer conversation about that. Energetic has been grant supported because there's a recognition of that we're a very efficient form of capital. If we think about the multiplier effect, how much money you have to put in an insurance reserve compared to the amount of dollars that are deployed to finance a project, we estimate 10 to 15x multiplier on that capital. So there are state, local, federal governments that we're in discussion with who see that and say, hey, Energetic, we want to go further. There are plenty of areas that you're covering. That's great. How can we push the envelope here and expand that risk envelope even further? And so there's a really exciting discussion for a capital efficient use of public dollars as well.
So for me, this has been a great conversation. I can really feel or see how this could help the industry. It could definitely change the game. And I think it's early innings here, so we don't know where it's going to all play out. But I definitely think that it will be interesting to watch. And if it's the right financial tool, it will be widely used. It's exciting to watch you guys grow. And I really appreciate you sharing with us today. Any final thoughts before we wrap up the program today?
Gosh, what a fun conversation. You guys are pros. I'm a huge fan listening to the podcast. You guys cover such a wide range of topics. I have no idea how you do it, but it's really wonderful. And I'm just grateful for the chance to be able to share the vision today and talk about how cool insurance is in project finance and renewable energy.
And I can't believe I'm spending my afternoon enjoying talking about insurance. Thank you so much for making this possible. Johan, any final thoughts?
No, you took the words out of my mouth. I thought we were going to talk about insurance. I was a little bit hesitant and how sexy is this? But I'm converted.
For those of you on the YouTube channel, we're all smiling. We're all having a good time. So
no, but I really appreciate it, Jeff, taking the time, because I thought it was really interesting. And what is also quite interesting, we're starting to see the kind of the blocks of actually this energy transition, where this is a kind of an enabler that fits well into the broader scope that you mentioned we talk about. So I think this was really, really good. Thank you.
Thank you. And for our audience, you spent another hour listening to Insider's Guide to Energy. We hope you've enjoyed this content. If you have, please share it, subscribe, like it. Don't forget to follow us on Facebook or watch us on YouTube. And we will see you again next week. Bye-bye.